Hello and welcome to our webcast series on the new not-for-profit T3 standard, AASB 1061. In part 1 of the 4-part series, we'll cover why we developed a new standard and its benefits, who can apply the new T3 standard, followed by a brief overview of what the standard requires in terms of financial statement presentation. The new standard was developed following a sustained period of engagement and multiple rounds of consultation with not-for-profit entities. We heard that many smaller not-for-profit entities found Tier 1 and Tier 2 reporting requirements too complex and burdensome. The AASB responded by developing a standard with simpler set of requirements that are easier to apply while still providing decision-useful information and supporting transparency and comparability across the sector. AASB 1061 introduces Tier 3 as a new level of financial reporting designed specifically for Tier 3 not-for-profit entities. This standard provides a simpler, more proportionate framework for preparing general-purpose financial statements. In other words, it's designed to strike a balance between the cost of preparing financial statements and the usefulness of the information provided to users. The T3 standard is available for entities that do not have public accountability, which means that they are not publicly listed and do not operate in a way that involves holding assets in a fiduciary capacity for a broad group of external stakeholders. And entities must also not be prohibited from applying the T3 standard by legislation, regulation, or their own governing document. So even if an entity appears to meet the criteria, still needs to check whether its regulator allows T3 reporting. Entities that would be expected to apply the T3 standard will include organizations like charities, incorporated associations, and cooperatives that are required to prepare general-purpose financial statements. Keep in mind that the standard itself does not decide which entities are eligible. That decision is made by regulators or other authorities. The standard simply provides the accounting framework once eligibility is determined. Another key point is flexibility. Even if an entity qualifies for Tier 3, it can still choose to apply Tier 2 or even Tier 1. Tier 3 is effectively the minimum reporting requirement, not a ceiling. Moving on now to look at financial statement presentation in the new Tier 3 standard. At the heart of financial statements is the concept of fair presentation. Financial statements must fairly present the entity's financial position, financial performance, and cash flows. This means faithfully representing transactions and events in line with the definitions of assets, liabilities, income, and expenses. When combined with the statements of changes in equity and accompanying notes, these form the complete set of financial statements required by the standard. There are also several fundamental principles that underpin presentation. One of the most important is the going concern assumption. When preparing financial statements, management must assess whether the entity can continue operating for at least the foreseeable future, typically at least 12 months after the reporting date. Another key principle is consistency, applying the same accounting methods from period to period so that the presentation and classification of items remains consistent unless there is a valid reason to change. Entities are also required to present comparative information, meaning prior period figures must be shown alongside current period figures to provide context. And finally, materiality is another critical concept. Information is considered material if its omission or misstatement can influence the decisions of users. This means entities must focus on presenting information that is truly relevant rather than overwhelming users with unnecessary detail. Thank you for watching this webcast and stay tuned for part 2 in this series where we dive deeper into the financial statements.